Protective is our sponsor guest today, and the topic, like you see on the screen, is protective asset protection. Let's begin with Doug Austin, our CEO here at Strategic Source. Doug?
Well, welcome everybody. We're glad you're here today. I'm Doug Austin, CEO of Strategic Source. You know, we began this innovative supplier webinar series about a year ago, May, and I think to date we've completed about 40 of these, and the intent is really to do three things: is to introduce innovative suppliers to our client base and prospects, and quite frankly to our employees as well, in different that have innovative solutions in different expense categories, audit and recovery categories, and new revenue categories. The idea is, our mission is to help our clients improve their bottom line. And certainly these webinar sessions are intended to do just that. So we are very pleased today to have Nicole Martin and Rob Johnson of Protective. They've got a very interesting program that we thought would be beneficial to our dealer audience, and we're excited to have them produce that session today. So without further ado, I will turn this over to Nicole and Rob. Thank you.
Thank you very much. And I see I just lost my camera feed, so we won't have my camera, but thank you so much for having us here today. We absolutely appreciate the opportunity to talk to you. If you're not familiar, we are Protective Asset Protection, and we are an F&I products and services company that's based out of St. Louis. We are in the F&I profit participation space. We are known as the inventor of the dealer-owned warranty company, and our specialty is in the area of F&I back-end profit participation programs. So just to kind of level set and get a little bit of a better feel for you, we wanted to kick off with a poll question to get a sense of your familiarity with the topic of F&I profit participation programs. Okay, this is really helpful to know. So the majority of you say you have little to no knowledge, which is great. That'll give us a chance to get everyone caught up. Perfect. 14% say they know enough to be dangerous. 14% say they are confident. So we welcome the opportunity to talk to you. Again, my name is Nicole Martin. I'm the Central Region Director for Protective. I'm joined by Rob Johnson. Rob is in charge of new business acquisition for Protective, and some of you might already know him as the guy who's maybe talked to you or called on you trying to talk to you about this topic in your dealerships. Our goal for today is to get you thinking about the full profit equation when it comes to F&I. All dealerships are concerned about PVR in their F&I department, or how much they're making per deal, and that is important. However, that really only is half the equation. It's worth the effort to really think about how well is my back-end program optimized. There are a lot of factors that come into that. You know, what am I paying in fees? How much am I getting in investment returns? What about commissions? What about hidden fees? There's a lot of factors that will make the difference in how much wealth you create over the years. And I will tell you that even the most inefficient of these programs still make dealers millions of dollars. So it's a very important topic. Now, you might not have dug into this topic in the past for a couple of reasons. Number one, some of our competition doesn't have more than one option. So if you choose to do business with them, you might be just choosing the partnership and not the profit participation program. Or there may be hidden fees that they don't really want you digging into, so they don't get into a lot of the meat and potatoes of the program. These programs sometimes, I believe, are vague for a reason. Now, when we talk about profit participation, we're talking about the money that the dealership can make after the sale of the service contracts, the tire and wheel contracts, the paint and fabric contracts. It's the underwriting profit that normally would have been held by the insurance company. And these programs give the dealership the ability to participate in that underwriting profit and all of the other financial advantages that come along with that. So our program topics for today will include an overview of the most popular profit participation programs in the market today. We're going to talk about the pros and cons of each program. We're going to dig into the DOWC, which stands for the Dealer-Owned Warranty Company. That one is the one that many dealers are not very familiar with. It's the most profitable of all the programs, so we're going to get you real familiar with that today. And then Rob is going to take you through an actual dealership case study where we show you a side-by-side financial comparison between a very popular competitor's program and Protective's DOWC so that you can see line by line how you can make more money in a dealer-owned warranty company. And lastly, we'll talk you through the steps of what you can do if you want to assess your current program and get a better feel for if there may be a program out there that is a better fit for your needs. So I'd like to kick off our second poll, and our second poll is asking, what program is your dealership currently in? Reinsurance, retros, a DOWC, maybe you're not participating at all right now, or maybe you're just not sure. Okay, it looks like about 60% of the callers are not sure the program their dealership is on. 20% say they're not participating, so that's a tremendous upside potential there. And then 20% are in reinsurance. Right now, we've got no one on the call in a retro and no one in the call in a dealer-owned warranty company. So what you're looking at on the screen here really represents two things. This is a representation of all the popular profit participation programs that are in the market. And Protective is proud and happy to say that we offer all of these programs today because not all dealerships have the same needs. And it's important to match the program to what you're trying to accomplish. Secondly, this visual represents the timeline of profit participation programs in the marketplace. The first program, and none of you are on this today, it seems, but it's still worth talking about, and that's the retro program. Retros were introduced about 30 years ago, and they're really just a volume bonus. They're a volume bonus that's tied to a loss ratio. So what that means is if your dealership wrote, let's say, $100,000 of premium in a year, and your contracts had a loss ratio of 70%, at the end of the year, your dealership would be paid a check for around $30,000. A little less than that because there's some fees they take out with retros, but around 30 grand. The advantage of a retro is it's very, very simple. The disadvantages, however, are that they're taxed at the full corporate rate. So the dealership receives the check as ordinary income and you pay full taxation on that amount of money. The second negative about a retro is that it's a forced distribution. So your dealership gets that check once a year, whether you're ready for it or not. Maybe you'd rather hold off this year. Maybe your accountant's telling you to hold off, but you don't have that freedom. So it's really considered a forced distribution. The third negative of a retro is that you don't get any investment income. So you're getting a check once a year, but your insurance provider sits on the money for the year and you can bet they're investing the money and they're keeping that investment income and typically not sharing that money with you. So overall, we can confidently tell you that the retro is the least profitable of all of the programs. However, it's not to say that there isn't a need for a retro. There is. If you're a dealership that's thinking of selling in the next couple of years, a retro might be the right program for you. Most of the publicly held auto groups are all on retros. So there is a need for the retro program. It's just not the most profitable. Now, reinsurance is in the middle of your screen. There's two flavors of reinsurance. There's the CFC, which is called the Controlled Foreign Corporation, and the NCFC, the Non-Controlled Foreign Corp. Reinsurance solves for the weaknesses of retros, and that's why it's considered to be an evolution. In reinsurance, you get a better tax environment. So instead of paying full taxes like you do in the retro, you are able to take advantage of something called an 831B election. And what does that mean? It means you're not going to pay taxes on your underwriting income. You're going to pay tax on your investment income. Yes, in reinsurance, you pick up investment income. You're allowed to invest your underwriting premium roughly 20% in the equity market or the stock or EFT market, and about 80% in bonds and money markets and cash and other cash equivalents. So most reinsurance companies earn usually about 3% interest per year. And that's a lot better than in the retro where you get no investment income. However, these are really regulated. You pay a little bit of taxes. You pay tax on that investment income. You pay a state premium tax as well. And there are a couple of negatives with reinsurance. Number one is in order to get the tax shelter, you have to be formed offshore. Most of these are in the Turks and Caicos or the Seychelles Islands, and some dealerships just are not that comfortable with the offshore nature of CFCs. The other negative is there tend to be a lot of fees with reinsurance. There's some that occur above the line, and there are some that occur below the line. When we say above the line, what we mean is all the fees and commissions that come out after you send the check to your provider, but before the funds hit your statement and your account. The below the line fees are those fees that come out on your statement after the money hits your account. The bottom line is reinsurance makes dealers millions of dollars. It's very popular. It's been around for a long time, but it tends to be pretty fee heavy. And a lot of those fees, depending on your provider, are not disclosed. The last weakness of reinsurance in a CFC is that there's a premium limit. For 2023, that limit is $2.65 million. So if you're in a dealership group writing more than $2.65 million, you're too big for a CFC. So you're going to need more than one CFC, or you move to the right into the NCFC. The non-controlled foreign corporations are reinsurance. They're fully offshore. There is no size limit. So the larger groups are in this structure. An advantage is you pay almost no taxes. They pay just a 1% excise tax. They've got a little bit more flexibility than the CFC in how they invest their money. So you get a little better investment returns than you do in the CFC. But there's some negatives that you need to be aware of. The biggest negative in an NCFC is control. The reason for that is an NCFC is really a group of 20 or more dealers that get together and own shares of a larger company. And because it's shared ownership, there's a board of directors. The board of directors makes the decisions. They decide how the money is invested, who gets to be part of the NCFC, how often the NCFC meets, and how often you can take a distribution. So let me give you a real example. Let's say you're a dealer that wants to buy a new store. You know you have NCFC money available and you want to take a distribution. Well, you've got to put a written request into the board that you want your money out. You have to wait for the board to meet. The board meets, they say, yes, you can take your money out. And then they set a distribution date, which is frequently months in the future. So if you're trying to act fast and buy a dealership, an NCFC might not be a great way for you to go because you don't get great access to cash, or at least not quick access to cash. The dealer-owned warranty company really solves for all the weaknesses of the programs before it. The dealer-owned warranty company combines the simplicity of a retro, the availability or access to cash of a CFC, lower taxation like an NCFC, and a lot more control overall. So let's dig into that because that's the program that you're probably the least familiar with and the program that is our greatest expertise. A dealer-owned warranty company, first and foremost, is domestic. So unlike a CFC or an NCFC, this is a fully domestic program. In fact, it's a simple C Corp. It's a C Corp that is formed right in the state where you're operating. The reason why dealers, in fact, we've had about 600 dealers come on board with Protective's DOWC in the past few years. And the reason they do it is multifold. Number one is it gives you access to 100% of the underwriting profit. So it gives you access to more profit than any of the other programs. It gives you more flexibility when it comes to investments. It gives you not only a great tax shelter, but it gives you completely tax-free growth. And it gives you greater control and more transparency than any of the other programs. Let me break down all the advantages of being in a DOWC. DOWC has a number of financial advantages and a few non-financial advantages. The first one is how a DOWC is taxed. A DOWC, again, is a state-based C Corp that's a property and casualty company, and it's taxed differently under the IRS. The IRS treats a DOWC under the rules of retail insurance accounting. What that means is you get a long-term tax deferral. Now, they call it a deferral, but really it's a tax-free growth period. Our typical DOWC goes anywhere from about 7 to 10 years of tax-free growth. So you can think of it like a 401k. You're able to put money in, you're able to invest that money, gain appreciation and investment income, and not owe any taxes until 7 to 10 years from now or until you withdraw money. When you withdraw money, you pay a capital gains tax, but you don't owe any taxes along the way for a multi-year period of time. How long that time is really going to depend on the size of your dealership, and we'll tell you that if we get the chance to really look at your operation. The other advantage of the DOWC is that it's got the lowest fees of any program out there, and the fees are fully disclosed. So when you do business with a Protective DOWC, it's unlike anything you've ever been involved in before. We give you a list of all of our admin fees. You have an admin fee per product you sell, and it's disclosed, and you actually initial off on it. And none of those fees can change unless you initial off on them again. Going forward, we send you an invoice for those fees. So if you sell 100 service contracts, we'll send you an invoice for 100 service contracts times the admin fee, and we ask you to send us a check. What this means is we never touch your money. And that's a beautiful thing. So gone are the days of your office manager sending a check up to your provider, because that's when they slice and dice all your fees. That's when the commissions and the fees and the taxes and everything else comes out, leaving you with less money. We talked a little bit about investment returns, and DOWCs fall under different rules and regulations than reinsurance. When you're in reinsurance, you can only put about 20% of your money in the equity market. And at the end of the day, reinsurance companies typically only earn about 3% because the rest of their money is in cash-like equivalents. They're sitting in bonds and money market accounts. So 3% is typically the best you can do in a reinsurance company with your unearned premium. In a DOWC, the rules are different. You can put 40% of your unearned premium in the equity market and eventually as much as 50% in the equity market. And what that means is DOWCs typically earn 3 times the rate of return than CFCs. Let me give you a specific example. During the 10-year period between 2005 and 2015, your average DOWC made over 7% return. During that same period, CFCs were earning less than 3%. We quote that 2005 and 2015 decade for a reason, and that's because it included the downturn of 08 and 09. And so we figure that quoting that decade is a really conservative look at the kind of returns you can get through a DOWC simply because the regulations are different. Now, when you own your own warranty company, it's your company. You get to name it. You get to name control of coverages, eligibility. You can tweak with the rates. There's a lot of control that you don't get when you're in any of the other programs. And let me explain why. When you're in any of the other programs, and even for you guys that are not participating right now, you are in a nationally footprinted product, meaning the provider uses the same contract for all dealers in all states. They cannot customize anything for you, because if you want something changed, they have to change it for all dealerships in all states and get it approved by all, involved entities. And it's just not feasible. But when you own a dealer-owned warranty company, it's your company. And Protective gets your contracts approved by your state and your lenders. So let me give you a for instance. We were recently talking to a dealer in Wisconsin who sells a lot of sports cars, and those are garage queens. And they wanted to be able to get coverage that lasted a long time, but really low mileage. So let's say 7,000 miles per year is the average amount of miles driven. We were able to turn around customized contracts for them within a couple of weeks that were low terms, like 7,000 miles a year for 10 years of coverage. So we're really able to customize for what your dealership and your customers need. Now, another advantage when you're the warranty company is you guys get to keep the cancellation fees. So NADA will tell us that about 15% of all contracts are canceled every year for one reason or another. Right now, your provider is collecting a cancellation fee of probably $50 or $75, but when you own the warranty company, you get to keep that money. And that's a brand new revenue stream that you don't get today. Last, but certainly not least, is another unique advantage of having your own contract. And that is what we call a service radius, or a right of first refusal on your service contracts. And the way that it works is, there's writing in the contract, the service contract, that says that if there's a mechanical breakdown, your dealership has a right of first refusal to bring the car back to one of your stores to get the repair done within a certain radius. And that's valuable for a couple of reasons. One is, if you can get the car back to you, you guys know this, you get the parts profit, you get the labor profit, you control the customer experience, you own the customer relationship, but you're also preventing some other service department from reaching into your pockets if you have a reinsurance company and upselling against your contract. So this is very valuable. And again, in most of these other contracts that have a national footprint, you simply don't have that control or that flexibility. Now, your average dealership probably has a 60% sales to service retention. Some of your top performers in 20 groups have close to a 70% retention. We did a review with one of our dealers yesterday who currently has an 85% sales to service retention without even trying. You don't have to hold retention meetings anymore. It's really kind of set it or forget it when you're able to let the DOWC program and the way the contracts are written work for you. Now, some of the things that dealerships typically want to ask when we're teaching them about the DOWC for the first time is, is this risky? Who's the obligor? Am I on the hook? Is this self-insurance? And the answer to all those questions is no. The Protective DOWC is called an Administrator Obligor Program, an AO program. What that means at the end of the day is that our DOWC is not any riskier than any reinsurance program. And that's because Protective buys an insurance policy on every one of your contracts, and it's called a CLIP, a contractual liability insurance policy. It's the same thing that exists on your reinsurance contracts. And what it means is, if your DOWC were to become insolvent and flip to the negative, we would not call out to you to deposit money into the position. We wouldn't give you a margin call. Our insurance contract or our insurance policy would step in and make good on those contracts. And that protects your name in the marketplace, and it protects you from having to come up with more capital. So, and it's an important part of the program, and it really gives you and your customers all the confidence that you enjoy in your your current programs today. But there's more to it. When we're the administrator, you pay us an admin fee for every contract, which is the same as what you do today. Today, you're paying an admin fee for every single contract your finance department sells. The problem today is you probably have no idea how much that admin fee is because it's not disclosed like it is with the DOWC program. But what you get from us for that one flat disclosed admin fee is not only the CLIP insurance policy, but you get our actuaries. Our actuaries are pricing all of your contracts. They're managing the risk. They're watching your loss ratios. They're preparing your monthly reports. We're doing financial reviews with you as often as you like, whether it's monthly, quarterly, or annually. And in most cases, we're doing in-store training and income development, providing an F&I menu. It's really a full service F&I solution. I briefly mentioned that in a DOWC, we never touch or control the cash. Now, this is huge, and I'll explain to you why. In a true DOWC, remember, you are the insurance company. So at the end of the month, when your accounting office is remitting or paying for all those contracts that your service or your finance department sold, they're no longer sending that check up to the provider. They're taking the check and they're sending it to your warranty company, because your DOWC will have an operating account with a bank and an investment account. And because we don't touch the money, you know where every dime is every single day. And that's a game changer in this space of profit participation, because those of you in reinsurance know how completely vague it is. You remit dollars, your accounting office sends a check, your money is sliced and diced, commissions, fees, taxes, all kinds of things are taken out, and you're left with some vague amount of money that gets deposited into your account. So with the DOWC, all that vagueness is gone. It's the most transparent program in the marketplace. Like I said, it takes all of the advantages of the other programs like simplicity, full service, risk management, confidence, and it gives you the best of all worlds. And it's absolutely the most transparent program in the marketplace that gives dealers the opportunity to make more money than in any other program. In fact, if Rob Johnson has ever knocked on your door, or when he does call on dealers, across the country, he tells dealers, if I had a way to make you 25 to 50% more money than any other program than you're in today, would you give me 20 minutes to explain how it works? And we do the math for you. And in a moment, Rob will walk you through a real life example of what it looks like for us to dig into a dealer's statement and prove to dealer time and time again that when we tell you that the program makes 25 to 50% more than the program you're in, it's oftentimes more than 50%. We've seen it 75% more. We've seen it double the money at 100% more. And we prove it by giving you a side-by-side operational analysis. At the end of the day, transparency is everything. Because we're not touching your money, and because all you pay with a DOWC from Protective is a fully disclosed admin fee, there is no opportunity for us to charge or collect all of the fees that you, 20% of those of you on the call that are in reinsurance, may be paying. There are fees with retros for sure. There are big taxes with retros. But with reinsurance, like I said, there's above the line fees and below the line fees. Some of those fees are what you're seeing on the screen. There's ceding fees oftentimes with reinsurance, depending on the provider, and some of you pay them and you may not know what they are. A ceding fee is really nothing more than a fee to deposit your own money into your own account. So imagine standing in front of a teller in a bank and pushing, a stack of cash over to the teller and asking them to deposit your money in your account. And they took a couple bills off the top and you said, hey, what the heck, what's that? And they said, oh, well, that's our deposit fee. you'd probably go somewhere else. Yet for many of you in reinsurance, this is happening every single month in your accounts. There also is no premium tax in a DOWC. Now, reinsurance accounts pay premium taxes every month, and they're based on the state that you're in. And what's worse, I hate to say it, but some providers actually mark up premium tax. When we dig into dealer statements, we know what premium taxes are state by state, and sometimes we'll see a premium tax is supposed to be, say, 2.1%, but lo and behold, on a dealer statement, it's 2.5%. What's that all about? Well, the provider's rounding it up, and guess what? The difference they're taking as a profit stream for themselves, believe it or not. I mean, imagine in your dealership if you were rounding up taxes and taking the money as your own income. That would probably be a problem. There's no excise taxes in a DOWC like there is with NCFCs. There's no loss adjustment fees. Now, loss adjustment fees have gotten a lot of negative attention lately, and a lot of dealerships pay them and don't know what they are. A loss adjustment fee is worth knowing about. A loss adjustment fee is a common one with reinsurance, and it varies by provider. And in fact, Protective has done such a good job at shining a light on this one that a lot of providers have been kind of backing down when they get called out on it and are reversing these out. But a loss adjustment fee or an LAE fee is essentially a fine or a penalty because you had a claim. So what happens is the customer comes into service, they have a service contract, they have a breakdown, and they have a claim, let's say, for $1,000. Your service department sets up a receivable for $1,000, and your reinsurance account is expected to settle that, which they do. Your provider, you would think, reaches into your reinsurance account and pulls out the $1,000 and pays your service department, and everyone's happy, customer's happy, service department's happy, and you call it a day. But if you are paying a loss adjustment fee, what they do is they take out more than the $1,000. They take out an extra 10% or an extra $50. And so, that $1,000 is maybe $1,050 or $1,090. And they take that extra money for themselves as a fine or a fee to pay that claim. Well, the last time I looked, that was what an administration fee was for. That's what the admin fee is for. So this is really kind of double taxation, if you ask me. And we don't have them with the DOWC. There is no such thing. We don't charge any claims fees. We don't charge any segregated sell fees. We don't charge any luxury rental fees. We don't charge any trust fees. We don't have hidden fees. We don't have any just because fees. It's a totally transparent program. You get an admin fee for every contract. You sign off on it, and that's it. And that's one of the very many reasons why this program is so profitable and so, popular for dealers. They love the transparency. They love the control. I want to kind of sum up this section by giving you a visual that really encapsulates the difference that fees and commissions and taxes do to your overall profitability of your profit participation program. The pie chart here represents the total cost of a vehicle service contract. So let's say that your finance managers see the cost on the contract as being, $1,000. With our DOWC, the $1,000 cost that they're seeing is really made up of three simple things. The first thing is the packs and the over remits that your dealership or your dealer sets. The internal packs and the over remits or the escrow money that they're getting back on every contract. And that's something that's set up by you. That purple slice there is your money set by you, controlled by you. The orange slice is the admin fee, and that's the money that we get for administering the program, for ensuring your book of business. Our claims adjusters get paid, our actuaries get paid, our account reps and trainers in the field get paid. We do all your bookkeeping and reporting and all of that. That all comes out, maybe there's an F&I menu in there. That all comes out of your admin fee, and it's baked into the cost of the contract. Every penny left over is reserve, and the reserve is the amount of money to pay claims and be invested and eventually be withdrawn or spent by whoever owns the DOWC. That's all your money. It's very simple and straightforward. Now let's compare that, on the other hand, with what it looks like in other programs like retros and reinsurance. We can call it death by 1,000 cuts, because there's an admin fee coming out, but who knows how much that is, because that's not disclosed, and it might be a lot more money than you would expect. The PACs are still your money because, you've set that money, the internal PACs, the over-remits, that's still your money. But slices come out, a federal tax is going to come out if you're in a reinsurance position. A premium tax is going to come out if you're in a reinsurance position. A ceding fee is probably going to come out. And, we've seen these ranging anywhere from 2% to 10%, depending on who the provider is. A loss adjustment expense may come out if you're with a provider that is charging those. And at the end of the day, the reserve is the amount of money that's still left over to pay those claims and be invested. But look at how much smaller that slice is. And what's so important for you to realize, if you're the owner or principal of a dealership, and if you are making decisions around profit participation programs, is that blue slice, that reserve, that's your money. And the more money that's in the account, the more money you have in the account to pay claims, the lower your loss ratios are going to be, the more money you have to push across to your investment manager to invest, the greater your returns are going to be because you've simply invested more money. And the more that's going to be left over at the end of the day when this entire thing runs out. So, we call it death by 1,000 cuts for a reason. And that's because all these fees and taxes and commissions really have a tremendous impact on the profitability of the position. And that's why we can so confidently say that a dealer-owned warranty company will make you 25 to 50% more than any program that you're in today. And I'm going to turn it over to Rob, because Rob is going to show you, what he does, how he rolls up his sleeves when he's dealing with a prospective new dealer, and how he shows you and proves to you how the program will make you more money. So Rob?
Thank you, Nicole, and thank you everyone for joining us today. Yeah, I'm Rob Johnson, and I report up to Nicole, but my specialty is new business development. Nicole kind of talked about it. 90% of my job is knocking on doors and introducing myself to dealers. And it's a really simple question. It's, if I can show you something that'll make you 25 to 50% more, would you give me 15, 20 minutes to sit down and just learn about it with me, right? And that's what we're doing today, is we're learning about. That's really what that presentation was that Nicole just brought you through. This stage in the conversation is, once we get through that with the dealers, we say, let's prove it to you. And it's my favorite part of the conversation, because we get to come back and we get to take their data and we get to take their position that they're in today, and we get to say, is it 25%? Is it 50%? Or like Nicole alluded to, is it more? And I tell you what, when we come back to prove it, it's my favorite part, because I got to look a dealer right in the face and I got to say, hey, I'm batting 1,000. There has not been a comparison that Nicole and I have done, and we've done a lot of them over the last couple of years, that isn't in that 25 to 50%, if not more range. And so what I did was I took a look at a recent acquisition that we made of a 5-store group right here in the Midwest. And I thought it was a perfect case study that kind of encapsulates everything that Nicole just went through. And it really takes a good look at a couple of the pitfalls that we see in CFCs, reinsurance controlled foreign corporations. And so what we found with this group, like I said, is a 5-store group. And what they were doing is they were splitting their business. And what I mean by that is they didn't have one specific provider between the group. So they were splitting the business in 2 different ways is what I found out when I started doing this discovery work, when I was looking through some of their statements. They were sending a portion of the business up to one of their manufacturers. It was a manufacturer that they were very loyal to. They were sending about 828 vehicle service contracts a year up to this manufacturer, and they had a reinsurance position just with that book of business. And then they were sending about 1,700 up to a third-party administrator through an agent partner of theirs. Now, the agent had sold his agency, and so the dealer said, hey, let's take a look if there's a better mousetrap out there. And it happened to be at the same time that I was knocking on their door saying, I have something I can show you that'll make you 25 to 50% more. So he said, come on in, we'll talk about it. So he's sending 1,700 up to provider B, we'll call it, this third-party administrator, and 828 up to the manufacturer. Now, it's important. The reason he was splitting the business is because, like Nicole mentioned, there's a premium limit. If he was putting all of it into one CFC, into one reinsurance position, he was going to have too much premium going in. He was going to trip that 2 point. Next year, it's going to be 2.65. Over the last couple of years, it's been 2.4, 2.3, 2.2. It goes up year over year slightly. So he had to have 2. Well, when you have 2 different books of business, you're having multiple layers of fees, right? You're paying multiple things. And in this example, the 2 CFCs that he was in, it's the perfect case study because they were the 2 biggest pitfalls that we see when you compare a CFC to a DOWC. And those pitfalls are getting hammered on fees and lack of transparency. So what we did is we took his book of business, we came back and we said, if you just did exactly what you're doing today, but you just did it under one roof with one DOWC, because you're not going to have that $2.65 million premium limit, and it's transparent, what would that look like for you? And on top of it, he wasn't participating in any of those extra products, those tire and wheel products, those key products, those theft products, paint and fab, he wasn't participating in. And so we're saying, hey, look, this is your warranty company. We want to put as many contracts as we can into this thing. And you can put all these contracts into there because, again, you don't have to worry about that premium limit, which is great. And so what we found was with the factory was that case study of they were getting hammered on fees. Now, I'll give this factory a little bit of credit. They disclose what those fees are. And I say disclose, if you looked at their statement, it's called a session statement. You've probably seen some of these before, and it's tough to make heads or tails of what you're looking at, and that's okay. That's what we do for you. But when you looked at it with this manufacturer, they had a 23% seeding fee. 23% seeding. Nicole talked about that's the fee to deposit the money. And I'll give them credit. They put it right there on their statement. Now, they didn't say it's 23%. They had the number there. So you just do a quick little calculation and you find out that it's 23%. So the factory is hammering them with fees. And I'm able to show them that. Now, I'm not able to back into what their admin fee is because this factory doesn't make it easy to match up the remittals. In other words, the contracts that they sold with the money that's actually being put in. But I'm able to point right to the statement and say, hey, it's 23% that's getting taken out of your pot of money, right? That's a below the line fee, 23% that in the DOWC you're not going to pay. So for this example, it was about $1,000 was his average premium, $1,074 times the 23%. That's $247 per contract that he's going to save immediately day one when he switches to his own or her own warranty company. Times that by the 828 contracts I was telling you about, that's $204,000 annually that he's going to save immediately, which is powerful. But it doesn't end there. They had other fees on that statement as well with that factory. There was the LAE, which is that loss adjustment fee, and they had a trust fee along with some other fees. It all came out to about 0.7% was what the fee was. Not a lot, right? Compared to the 23%, 0.7 doesn't sound like a lot, but it adds up. And it answers the question is, how do we help you, Mr. and Mrs. Dealer, keep more money in your program? And so we took that 0.7, again, protected. There's no additional fees. It's that one admin fee that you're going to sign off on that's disclosed before we ever sell a single contract. The 0.7 times that same 1,074 is $7.52 a contract times the 828. That's $6,000 saving per year. It's peanuts compared to the 204, but it adds up, everybody, right? What if this guy goes and buys another 2 stores? That's more premium that's going in. That's going to be added to that $6,000. It's all savings. It's all his or her money. Now, the next was, that was just the one example. The next was this controlled foreign corporation with the third-party administrator. with the agent. Now this one, what they were doing is they were playing the hide the, move the shell. It's the shell game for these guys. These guys didn't disclose any of their fees on their session statement. So what I had to do was do a little back end, kind of forensic accounting where I was able to match up what they sent to their provider, what the provider took out, and then what the provider ended up putting into their statement or into their company. And what I found was when I did that math for the dealer, it was an effective admin fee of $297 versus ours. In this case, it was $185 admin fee. I'll note that our admin fee is going to vary based on the size of the dealership, based on the location and the level of service that you need. In this case, this was a dealer that needed full training, full support. We're going to be in there multiple times a month, $185, fully disclosed. But it was $297. In the meeting, I'll never forget this. One of the partners said, Rob, I emailed my agent yesterday. I asked what my admin fee was. He said it was somewhere around, it was like $205. And I go, he goes, are you lying or is he lying? And I said, well, neither of us might be lying about the admin fee. And he goes, what do you mean? And I go, the admin fee might be $205. What you didn't ask was what are all my other fees? Those just because fees that Nicole was talking about. It came out to $297. And I proved it clear as day. Oh man, the smoke that was going on in that room when we had that conversation, it was interesting. But all this is adding up. The premium tax savings, like Nicole mentioned, it's 2%, was 2% in this state. Times that by all the premium they were selling, it was $37,000. And I'm clipping along here. I want to make sure that we stay on time here. We promised you a good amount of time. I think it was 45 minutes. So I'm going to kind of move along here. But I hope you're kind of really understanding the value of this, or really the power of all these savings. $37,000 in premium tax that you're not sending to the state, you're keeping in your company. Greater investment income. Nicole talked about this one. We love giving the benefit of the doubt to a reinsurance company. These guys, they were making less than 1% on their investment income. But I always play conservative. I say, hey, let's assume that your reinsurance could make 3.5%. It's easy math for us to do it this way. We're going to run your numbers at a 7% investment rate of return, which is that average. It's actually less than the average from that 2005 to 2015. But if you had 7 versus, even if they could get you that 3.5%, you're going to make $338,000 more annually when you annualize it over the 10 years, which is powerful. But hey, if I'm going to give them the benefit of the doubt on the 3.5, I have to tax them on the 3.5 too, because remember, in reinsurance, you're going to get taxed on the investment income starting day one. So that $338,000 isn't really $338,000. So it's going to be $70,000 less. You're saving the $70,000 on that $338,000. And then last is that cancellation fee. You're the warranty company. You're going to keep that cancellation fee. Protective's not going to keep it. You are, because you're the warranty company. NADA says about 15% of contracts cancel before they mature. Times that by $75 was the state max. And in this state, 383 contracts are going to cancel a year. That's $28,000 more in your pocket, Mr. and Mrs. Dealer. What we then do is we take all of it and we add it up and we say, hey, what would this look like for 10 years? If you start today and we write for 10 years and then we stop, what did we save you in those 10 years? And it's pretty simple. We just take all those numbers I showed you and we are going to times them by 10. So we got $2 million in that seeding fee, right? The fee to deposit monies. $62,000 in those other fees that manufacturer was charging. The effective admin fee that the agent was charging, $1.9 million in savings. Premium tax is going to be, and my thing is $378,000 over 10 years. Additional investment income, an additional $3.3 million. Even if they were able to make that 3.3, you're going to save another $750,000 on the tax that you'd have been taxed on the 3.3. And then lastly is that cancellation. How about $250,000 for customers canceling their contracts? That's not too shabby. We look at it and we say, at the next 10 years, if you don't do anything else, if we don't come in here and help you move your numbers and you just keep doing what you're doing, you're going to make an extra $8.8 million, Mr. and Mrs. Dealer. But that's not how much the DOWC is worth. No. The DOWC is worth to you after the 10 years and you run that thing off. If you didn't sell another one, it takes about 7 to 8 years to run off. $32.2 million for this dealer. 5-store group doing about, 2,500 service contracts a year. So you can start kind of doing the math yourself. I looked the dealer in the eye and I said, I lied to you. He said, what do you mean you lied to me? I said, I didn't make you 25 to 50% more. I made you 59% more. Because we're going to add those ancillaries in there as well. He wasn't participating in any of those. And so I'm going quick. It's 152 and I wanted to kind of stop at 150. But this is what I get so excited about. When I get in the car and I go knock on a dealer, door and I say, hey, confidently, I can make you 25 to 50% more. It's things like this. And this is powerful because it's the dealer's number. There's no juice in here. There's no, hey, we're going to boost PVR and that's how we're going to do this. Absolutely not. This is if you're doing what you're doing today and you switch to doing business with yourself with the help of Protective, we'll make you $8.8 million more for whatever it is in your case. And we're happy to help you find out what that number is. So Nicole, I'm going to kind of turn it back over to you to maybe talk about next steps and maybe see if we have a little Q&A.
Sure, absolutely. So if you want to really get a diagnosis of what you're paying and whether or not there might be a program that would be a better fit for you, we are happy to help. We're going to give you our contact information here in a minute. And, we like to collect your statements and we begin digging in and rolling up our sleeves and doing the forensic accounting to back into exactly what you're paying and what you would be paying with a dealer-owned warranty company. So we'd like to take any questions.
All right, reminding people that you can click on the Q&A button at the bottom of your screen. That's the one to ask any questions of Rob or Nicole, and we'll try to cover as many as we can. So let's bring up your contact information on the screen as we get ready to hit this part. Just a moment. Here is this first question. How much does it cost me to start?
Okay, that's a good question. Very, very little. This is a C Corp. And, a basic C Corp, we've got an attorney that we refer dealers to get one of those set up. They charge about $2,500. There's a couple little incidentals, but, it's really under $3,000 total to really get your DOWC set up and running.
Mm-hmm.
All right, here is another. If this is so much more profitable, why isn't everyone doing it?
Good question.
Yeah, good question. I would answer that two ways. Dealers that take the time to sit down with us and learn about the dealer-owned warranty company and give us their statements so we can dig in and do a side-by-side. We have close to 100% closing ratio on those. The hard thing is getting in front of dealers. You know how hard it can be to get in front of a dealer principal or a decision maker in dealers for whatever reason. Sometimes it's, you like your guy or you're not shopping or you're not currently unhappy. And that's really our challenge is to get, dealerships to take the meeting and learn what they might not be aware of. The other second reason why maybe not everyone is doing it is we have a self-imposed size requirement. Because our admin fee is fully disclosed, our margins are small. Our margins tend to be slimmer than typically with reinsurance. And because of that, it needs to be worthwhile because our margins are smaller, but the amount of effort it takes for Protective on the back end to administer the program is greater. And so we say that a dealer needs to sell at least 50 vehicle service contracts per month in order to be eligible, plus all those ancillary contracts, but they need to do at least 50 service contracts per month.
If I can add, Nicole, too, back to what you're talking about with that, we call it that, rainbow slide where you showed all the different participation models. It's evolution, right? Why isn't everybody doing it? It's going to take some time. I truly believe in the next 5 to 10 years, dealers that qualify, that are doing reinsurance today, everyone's going to be on one of these things. I truly believe that, but it's similar to, listening to music, right? When the iPod came, not everyone went out and bought an iPod right away. They weren't totally sure how I'm comfortable with my CD player. Nowadays, how many people are listening to CDs, right? It's just the evolution of these programs. And so it's a good question. It's a good question. I'm out trying to introduce myself to as many dealers as I can to help answer that question a little more confidently.
Doug, we're nearing the top of the hour, so can we have you come back on for some closing comments?
Well, thanks very much, Nicole and Rob. This is really informative and really, quite frankly, eye-opening. In our 21-year practice in the automotive space, there is not a lot of interest, it seems, in looking at the F&I opportunity. I think it's relationship based, as you alluded to, Nicole. But holy cow, the opportunities seem pretty significant. So I would encourage any of the listeners here, attendees, to take a look at this. This is pretty eye-opening in terms of bringing new profitability to the bottom line. We thank you, Rob and Nicole, for your time today for this excellent presentation. For the listeners here today, just remind you, we will have this webinar up tomorrow, probably on our website at strategicsource.com. So you can find it there. If anybody is interested in this deck, the slide deck today, reach out to Chris Austin, caustin@strategicsource.com, or you can just shoot an email to sales@strategicsource.com. Text us 612-386-3898, and we can get a copy of this to you. But we thank you very much for your time and attendance today, and we look forward to you joining us again on the next Innovative Supplier webinar. David, back to you.
All right, let me bring up a post-session survey that we want to catch everyone for your feedback before you leave. So thank you everyone for your hours spent with us today. Thanks, Nicole, and thanks, Rob. Thank you, Doug. And we appreciate everyone's time. Have a great rest of the week, and we look forward to you joining us on future webinars with Strategic Source.